And I said, now I know nobody in this room would start to fall asleep, but if I was in most rooms, I would probably lose people at that point. So I said, thinking about it late last night as I was putting the presentation together, and I said, I need to tell this story through the lens of an all-time great American movie, The Karate Kid. So we did the presentation and related Johnny, who was the guy from Cobra Kai, as being stocks and bonds, and Daniel's son being Jacksonville Rental Properties, and just went through it all. And of course, we had Mr. Miyagi teaching Daniel's son to unlock his full potential and build confidence. And, of course, that was understanding the 5 profit centers. And so it was a fun presentation.
That sounds awesome, dude. So were you Mr. Miyagi? Who was Mr. Miyagi?
I was telling the story of Mr. Miyagi. I was kind of the play-by-play, I was kind of like your role as we were, breaking it down to the all-city championship, or the all-valley martial arts championship between Cobra Kai and Johnny and Daniel's son. And you'll love this at the end. I had worked to put this like GIF at the end of the thing where Johnny does the crane kick and Daniel does the crane kick and wins, and then the GIF wouldn't work. And so then everybody's like, Greg, you got to do it. So I did the crane kick to end the presentation.
Let's go.
It was a success. I didn't break anything.
Amazing, dude. Amazing. I am so upset that I missed this, and I wish that there was some kind of content that was being gathered, but that is for another day, because we're about to sweep the leg of this white collar recession, because we're officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. Today, we're back to our favorite Not Your Average Insights. I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC, because of his great concepts, because he generates cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
I got distracted by the fact that my name is GC. My name is Gregg Cohen on the Zoom thing. But of course, we have her back in studio, our amazing community manager. She brings us the moments that matter, and that's why we call her MTM Madison the Magnificent. Say hello, Madison.
Hello, everybody.
Welcome back. I know Madison was not feeling great, but you're back, Madison. Love to have you back in studio. It's great to have you in here. Now, I'm the one that's a little bit under the weather, so bear with me if I fumble across a couple of concepts here today. I'm going to try to keep the energy high. And, part of the energy thing is to keep you here. And if you're watching on YouTube, if you're listening on the podcast here in the future, the best way to like consume this thing, the best way to enjoy this is what you see.
Be here, right now, in the audience here at nyais.com. Come join the party, make a friend, and get ready for what, Pablo?
The roll call, baby. We got Madison welcoming everybody with a welcome to the Not Your Average Investor Show. We got Christopher Lee from Fernandina Beach in the house. We got our leadoff batter, GC.
John Henning in
the house saying hello, good afternoon. We got Jeff Wonder, past star of the guest investor of the week, our friend from the Vegas Fortune Builders Conference. Jeff Wonder in the house. Good to have you. We got the early bird, GC.
The early bird, Dean Curry, who just picked up the property of the week last week, I heard. Congratulations, Dean.
Let's go, Dean, making it hard for anybody else to scoop in on these properties. I love it, but you got plenty of those available. I am just talking out of my butt here. So, all right, we got the Duchess in the house, Karen Jensen, representing the first family in the house, the matriarch and patriarch of the first family, the Malines. Ooh, we salute you. Good to have you. We got our regulars from the second family, Rosalind and Gary Riley in the house. Greetings from Murrieta, California. We got Donna Chica is back saying hello, everybody. Thank you, Karen, for the feelings. We got Raj Bantu, my ride-along partner, Raj, from the IRL meetup that we had out here. Who else? We got Leslie Wilson, our friend in Denver. Leslie Wilson in the house saying greetings from snowy and freezing cold Denver this time. It's kind of funny because I feel like summer's back here in Jacksonville. It's
a long way from Cabo, Leslie.
Hopefully
she'll be down here soon in Jacksonville for the JWB Not Your Average Investment Tour. Can't wait to see you.
That's right. Speaking of somebody else who's going to be down here, our favorite name to pronounce, Into the Light. Darren O'Neill is in the house. We got Chris Gonzaga from where, GC?
The illustrious Hudson Valley. And we got Marilyn Cotterman from a warm Homosassa, Florida. What
What do you think happens over there, GC? What do you think?
That's where the manatees frolic.
The manatees thrive and frolic. We got the man that everybody knows as
Noah Randari.
Noah Randari. Greetings from California. We got Deborah Schwartz in the house. Deborah, welcome back. We got John Evans in the house saying hello, everybody. We got Hervé Francois saying, what up, JWB fam? Hervé, we mentioned your name earlier today because Gregg and I thought that we were wearing the same color shirt. And I was like, someone's going to have to let down Hervé easy because it's not. His is white and blue and mine is gray. So just letting you know, buddy. So we got Michael Santorios checking in. Good to have you. Who else? Eddie Harris from where, GC?
Atlanta,
home of the South. We got a not your average guest in the house saying howdy from New Jersey. I'm assuming that not your average guest must be the number one Gregg Stone.
Probably the better Gregg.
He normally says howdy. We got Joe Culler joining us from South Carolina. Is that a new name?
Might be a new name here. Joe's a client, so it's great to see you, Joe, and welcome to the party.
John Moran from Delray Beach. New name. John, welcome to the show. Welcome to the show. Love having you. We got Aaron Wilson from Powder Springs. I know I haven't said Powder Springs before. Aaron's definitely a new name, right?
All right. I think so. Welcome.
Bunch of new folks. Love it. Love having you here. Love making you part of the community. And we got the touchdown maker in the house.
Shannon Baker. I introduced the nickname to everybody on the team during my presentation today. So Shannon
How does
Baker,
she feel? How does she feel about it? She liked it?
How could you not? She makes touchdowns.
She loves it. It's confirmed. She loves it. All right. Welcome to the show, everybody. Today, we are doing our favorite content pillar where we just recap stuff that's going on, bring you our opinions. This one is specifically designed for you to participate, you to deliver your hot takes. We're doing, the Ringmaster joined a little bit late here.
Oh, Andrew Barnhill. Couldn't be a show without him.
Couldn't be a show without the Ringmaster. Mastering the ring of the Not Your Average Investor community here. So we're gonna kick it off with something we don't normally do, right? We got a clip that we want to show you. It's a little bit under 3 minutes. So this is where we're coming up with this white collar recession thing. We're seeing it in the news. We're seeing articles calling it a rich session. But this is expert Eddie Yoon. Actually, one of his books is right here on the shelf for me. His book, Super Consumers. He is a Harvard Business Review contributor, economist, business strategist, and he's the first guy that I heard talking about this. So I want to share this with y'all, and then we're going to have a little discussion about it to see what it means to us. Here we go.
Overall, consumer sentiment might be up, but I am seeing signs of a white-collar recession. So it might be a more targeted one among, say, higher income folks. As you see certain layoffs hitting people, Amazon hired 150,000 or is planning to hire 150,000 temporary workers this holiday, same as last year, but they laid off 10,000 corporate workers. And you've seen layoffs at Meta, obviously Twitter, and that this kind of seems to be hitting what I would say knowledge workers, but in particular managers of knowledge workers. And so the pain might be felt a little more acutely among a certain class of worker for certain parts of the GDP, because certainly consumer spending among those people is different than the macro overall.
When you look at everything, Eddie, what's your big picture here? Is there areas that may do better than others, or are we looking abroad? Because is there sort of a disproportionate feel for recession at home versus abroad? Because I don't think Europe's doing so great.
Yeah, no, it'll be very interesting how the dominoes fall. Clearly, we're seeing it in big tech that are very productive and frankly don't need a whole lot of people to be running, Google search business and that. And what you'll find is that the people that are making over $100,000 drive about half of all spending, and that there are certain categories where that number is even higher. So when you look at the consumer expenditure survey, 2/3 of what we would call fees and admissions category spending, so entertainment parks or movies, that's driven by these high-income workers. So I would suspect those categories to be hit harder, and that those folks are going to find that layoffs will have to come a little bit sooner there. So, you look at Bob Iger coming back at Disney, personally not a great time for him to do that, just given the tailwinds that he's looking at and facing there. 64% of education spending is driven by these 100K workers. So I saw some notes that supposedly Harvard has as many administrators full-time as they have students. That doesn't seem to be sustainable. 60% of mortgage spending is done by high-income consumers versus 24% of rental spending. So you're going to see that ripple into financial services, mortgage brokers, and then even things like 56% of alcohol spending is done by higher-income folks versus dairy, which is like 41%. And alcohol has such a wide range of price points that I think you're going to see people compressing down, trading down from high-end brands to lower-end brands, or even drinking less in some situations.
Eddie, you mentioned a lot of companies. You were talking earlier about the tech layoffs, and you were looking at companies like Amazon and Meta and Twitter. You mentioned Disney. You mentioned, Apple and founders of Apple. How do you think these companies will fare going forward?
Well, I think the ones that are making cuts now will definitely fare better. The smart money is getting ahead. Almost the smart money will use the tech company layoffs as cover to make their own ones. I think Carlos Brito, the CEO of Anheuser-Busch InBev, once said he only needed 200 people to actually run the company. And so I think you're going to see a lot more cost cuts, whether they are necessary or, again, want to use it as this time to kind of make sure that they have some balance for earnings. I think you're going to see consumers start to get a little bit nervous about that and also be very proactive about how they make their choices. There was a headline in the Journal today about how a lot of consumers keep leaving their savings deposits with the big banks that are paying them bupkis from an interest rate perspective. And why does that behavior make any sense? And I think you're going to see consumers start to get real active about, I need to change behavior and get off of inertia to really make sure that I'm making my money work hard for me. So I think you're going to see some real meaningful shifts in how people spend money.
Right.
All right, GC, this was something that we've been batting around, right? I sent this to you when it first came out. You've sent me some articles. When you're listening to this, what's the first thing that comes to mind here?
I just think that, when I'm listening to this, I'm thinking about making sure that my investment dollars are in assets that are not dependent on discretionary spending of white collar workers. I think it made a lot of sense when Eddie was talking about, and he had the data to back up, those who earn over $100,000 a year spend a certain portion, a large portion of the spending in those different categories. And you got to think in the recession that, we are likely going into that's going to be the first thing to go.
Yeah. That's where my head went too. The three things that stuck out to me when I first sent you this video, right? Like this idea that Amazon is hiring factory workers, but laying off office workers, right? And I always think about how JWB has these homes that one of the big kind of like fillers of residents for these homes are these Amazon logistic factories that are very close to this. The next thing that I hear is discretionary spending from over 100K earners are going to go down. He immediately calls out Disney, and I'm like, that to me tells me that Airbnbs are going to feel the same. Like people not going to Disney to me says this may not be the time to count on Airbnb's financial performance moving forward in the short term, right? So like if I have a short-term rental that I'm investing in, then I need to like reconfigure those numbers, make sure it makes sense. And then the third thing that I heard that I thought was really interesting is there at the end was that people are having this macro shift of like moving out of cash, right? Like I'm essentially hearing people are starting to get to the whys to the idea of like turning equities into income is basically what I heard in that thing.
Yeah, well, let's go over a couple of things that you were saying there, because that last point, let's just go there. I hope that people are doing that, but I actually think that it's still people just don't know where to go. I was just listening to the Wall Street Journal Money podcast, and it did a whole 10-minute segment on why cash is a better investment right now. And I texted you afterwards. I'm like, man, people need our show more than ever because people have the desire to go and make their money work harder for them. But if they're deciding that cash right now and inflationary times like we have right now is a better opportunity for them, and the Wall Street Journal is kind of saying, giving them credence that that's probably a better thing, that you're just going to lose less. They really need some help. So I think the desire to go and do it is there. I think the avenue and the execution for a lot of people is just not there because they don't have the education, they don't have the support, especially like we do here at the Not Your Average Investor community. But the other thing is that really jumped out to me, the fact that these companies are starting to make big cuts of their the type of jobs that they have. It's not all the same, right? It's not the same type of worker. So I thought that was a really good point. And I think so much of what I love about our asset class is that it's built on risk mitigation. It's that cool combination of risk mitigation, but also upside. And, I think mitigating risk is important in normal times, but when you're facing a recession that has been as telegraphed as this one is going to be, right? You of course want to focus on risk mitigation more than ever, but I just think like if you're not investing in something that is risk mitigated right now with as telegraphed as this recession is, it's really on you. Like if you're just sitting there and you're just investing like everybody else is in stocks and in bonds, which are supposed to be the conservative play, but they're certainly not keeping up with inflation. I just think you have less of an excuse. You have less of, I mean, it's not like this came out of nowhere. It's not like this was the pandemic and the, weird sort of recession that we had right after the pandemic. I mean, this is telegraphed. And so you have the opportunity to take control and not be a victim of this recession. And I think rental properties provide an avenue to do that. And I hope more people follow through on their desire to find something different.
Yeah, man, that's really well said. This does feel, I don't know, I'm trying to put myself in 2008, right? Like, and thinking that people talked about a bubble that was going to burst and things like that, but nobody really knew what was going to actually happen. I also think of the fact that like, this is the first recession where the internet is at scale, right? So like, even not the internet, but like social media and, the internet, the whole world's information is at our pocket for the first time ever, right? Like in 2008, like websites were still the dominant framework, right? Like you still probably went to Encyclopedia Britannica or Wikipedia to find something out, not just everywhere all the time, right?
Right. There were no meme stocks in 2008.
There were no meme stocks. You couldn't just push a button on your phone and buy GameStop and like whatever, right? Like, so this idea that the show is more important than ever, I think is real, right? Like this idea that there is no real excuse to like, okay, the variables of what's coming. People are making all these nuanced takes, right? Like you're able to find out really what's going on, like this white collar recession, this rich recession, not like others, because this is what's happening. And to be able to act accordingly, I do think it's one of these like giant opportunities. It makes me think of when Rich was on our show in 2020 saying that the debt is the deal. It almost feels like right now risk mitigation is the deal, right? Like capital preservation is the deal. Like there's no reason to subscribe to this downswing voluntarily.
Yeah. I mean, what is your excuse now if you're just sitting on the sidelines? When I say sitting on the sidelines, I mean, if you're still keeping your money in equities, knowing that we've got this serious challenge coming our way in the economy, you've got the fact that, it's really hard to see it any other way. I mean, there's really consensus among most people that there is going to be some form of a slowdown. There just has to be, because that's the only way that you solve inflation. And the Fed is going so strong that we cannot have inflation. And so it is general consensus out there. It's how much of the slowdown are you going are we going to see? Is it going to be a mild recession? Is it going to be a more severe recession? Is it going to be a soft landing? Whatever you think, it's going to be a slowdown. So you need to be thinking about where your money is right now and how those assets perform in a slowdown. And so you really have much less of an excuse, in my opinion, going into this recession than you have in past recessions. I think the internet at scale thing and the social media impact is really cool. I hadn't really thought about that before you brought that up, but yeah, I just think you really have less of an excuse.
Yeah, agreed. So we got a couple of good questions here in the Q&A in the chat. First one from Anonymous Attendé, all the way from France here, says, I remember GC mentioning about how many investors are from white collar workers. How much percentage of JWB investors are white collar? So I think what we're talking about here is like, we know that the resident in this asset class is generally workforce housing, right? So like these jobs that aren't immediately being cut right now, but investors are I guess they're trying to find out, like, do you have a sense of percentage of who's investing in these asset classes with JWB?
Yeah, I would say the vast majority of our clients are quote unquote white collar investors. Have typical jobs would be engineers or we have a lot of entrepreneurs as well, finance, healthcare, doctors, things of that nature. So yeah, so white collar would be describing the majority of the JWB client base. But really good point. This whole investment resides around your residents being able to pay rent consistently and stay in your homes for a very long time. And so the base that we serve from a resident perspective are not white collar. We serve we serve blue collar, right? Your workforce housing, those Amazon workers that we were talking about, hiring those roughly 150,000 is what Eddie was saying. Amazon planned to hire 150,000 temporary workers over the holidays, and beyond just temporary workers, your blue collar Amazon workers. Those are the types of jobs that our residents have, and those are the ones that we think are going to fare better in a recession, whereas white collar jobs and discretionary spending from white collar folks would largely come down.
Cool. All right. We got another great question here from Michael Santorios saying, Greg, along the line of this, KB Homes reported a 68% cancellation rate in Q4 of 2022. Rumor is KB is one of these like national tract home builders, for anybody that doesn't know that, is considering making these home rentals till the Fed pivots and they can sell them. In your opinion, how do you think this will affect the Jacksonville rental market?
Yeah, Michael, and I'll take it one step farther. Rather than it just being a rumor, I don't know KB specifically in their plans, but I can tell you that this idea of turning for sale inventory into build to rent inventory is absolutely happening here in Jacksonville and across the country. And I don't think it is just a short pivot. I think this is a new type of asset. This is a new type of asset class. And this has the institutional backing. I actually don't see it changing. I see this is a part of what private equity and builders will be doing. And I think it will change the landscape for how people rent homes, how people buy homes. You're starting to see builders in these huge communities section off part of the community for sale housing and part of the community for rent housing. You also see entire build to rent communities. And so, yeah, so I think it's beyond just waiting and seeing what the pivot or what the Fed is doing. I think this is looked at as a long-term sustainable asset class that private equity and builders want to be a part of. And I think that this can have some really great benefits to the end consumer as well. I mean, I envision, I've been hearing things as well as thinking about, you can go to one of these, if you're going to buy a home, and let's say you're going to buy a home from KB or a big builder, you might have the option to rent that home, or you might have the option to buy that home. It's, I think it is going to bring some real flexibility, talking about the amenities and the standards of property management. If you go over the last decade, have risen so much, and largely you tend to follow the money when things like that happen. And you see big money getting into single family rental properties, and they're taking this asset class, which has largely been managed by small independent property management companies, a lot of them accidental landlords, accidental property managers who were previously realtors. And you're seeing that transformed, and there's more companies like JWB who think differently, and there's more institutional property management that's coming. And this is going to be the backbone of build to rent communities. And I think that residents will have a lot more options and flexibilities. Even think about amenities that are improving. So I'm kind of getting off on a tangent here. I am really excited about that. And the question about how it affects the market, right? Of course, it brings more homes on the market for rent, decreases the amount of homes that are for sale, but it's really interesting to see how that's going to affect supply. We don't know. We've never really experienced this, and there's not a lot of data to show, well, is this inventory for rent? Is this inventory for sale? Is it both? Could it be either? So remains to really be seen as far as how it affects the supply side, but I'll make sure I keep you guys updated.
I'm glad you went into the excitement side of it, GC, because for me, I think about the fact that this is an asset class. It's a category of investing, right? And my fascination with category design and how being category king of an industry means that you get 76% of the market cap. And if I was sitting in your shoes, this idea that this category is maturing, right? Like the thing that you and I are always trying to make people understand is that there is a new way to invest. And right now, your market is kind of capped to the people that understand that there's a new way to invest. And this new way is professional property management by somebody that actually built the asset class for you, that is really, really deep in the market and is completely vertically integrated, right? So our job as evangelists of this like vertically integrated new approach of investing is tough, because we got to open the eyes of a lot of people that don't understand this is happening. But if KB Homes starts doing this thing and Wall Street continues to invest in this thing, then what that's going to do in the land of category design is open the umbrella, right? Like it's going to open up the tent. It's going to get this message to more people. And I find it really, really interesting that as that happens, JWB sits here as the category king of who's been doing this the longest, who was on the front page of the Wall Street Journal as the company that invented build to rent, right? Like I have to imagine that this, from a business proposition, all these other big players coming in, is a very attractive proposition for you who has already systemized, figured it out, put all the data behind it, right? Like the learning curve that everybody's going to have to go through right now is going to be pretty steep. And you're just so far ahead of it that as consumer understanding of the benefits of this thing catches up to the actual performance of the people that really know how to do this, there's a big market to capture for JWB.
I think there is. A couple things come to mind. I mean, this isn't the first time that a real estate asset class has become institutionalized. You go way back in the day, and apartment complexes were not institutionalized, right? They were not like they are today. In the 80s, the Wall Street came in and realized that apartment complexes were something that they wanted to invest in because it had better risk-adjusted returns. And you see now anybody can invest in an apartment complex through a REIT or some type of fund structure, and that those things are there after Wall Street has institutionalized the asset class. I think that's what has been happening in single-family rental properties. I think we're still in the early stages of this, but it is absolutely mature. It is crossed that chasm where money was sort of testing the waters for a little while, and you had some early adopters. No, and now it's not just early adopters. When you have big builders like Lennar, KB, these other big builders that have never in their entire company history built new construction homes to rent out for the long haul, and now are partnering with private equity, you've got something that's sustainable. So I think that's the way it is. And then, I think that it's like anytime that there's a shift, there are always opportunities to be had. And, this is something that I shared with everybody who tuned in a couple of weeks ago when we broke down JWB's business plan in 2023. I was sharing something that I hadn't really shared with you guys because it never really came up. But, over the last few years, JWB has been watching as this big money has been coming into Jacksonville and across the country, partnering with builders, looking for tracts of land to take those down and build single-family rental communities, do this build to rent at large scale. And, we are a turnkey provider or a vertically integrated provider for you as an investor. And we said, I wonder if we could create an opportunity for ourselves and for that end buyer there, that builder, private equity firm, institution, to where we could create a turnkey experience for them as well. And could we become a market leader in that? And so in the business plan I shared with all of you is we already have 4 such projects going on right now. 2 of them have already been sold to institutions, and we're continuing to develop the land horizontally and then build new construction homes. So this is actually happening. And we have 2 other projects that we're waiting to sell to the right institutional partner that we expect to happen this year. So JWB is building a part of our business plan to make sure that we can be there to capitalize on the opportunity as well. That's how much we believe that it's going to be something that's going to be here for a while.
That's so cool, man. As somebody that's like fascinated by this whole like category design thing, to be like living and working within the guts of a category designer that's going through like all the things that happen as your data flywheel matures, as the flywheel compounds into these other externalities, right? Like I see it no different than Amazon going from selling books to selling everything, to selling cloud service computing, to selling logistics, right? Like you guys are able to now turn and monetize all these different things that you've built these core competencies around because you focused on your inner circle. All right, so let's keep going with I don't want to make this a category design talk. I do, but I don't. All right, we got another Anonymous attendee. To your point, GC, Anonymous attendee says Jacksonville permitting info has a large increase in multifamily and apartments. right? Like what you were talking about, this institutionalized asset class. What impact can this have in vacancy rates for single family residences?
I mean, you would think if there's more apartments built and there's more supply for that same segment of the population to potentially rent for apartments or single family homes. But, I'm not concerned about the effect on single family homes, knowing that we've had such a boom, especially in apartment builds as well as single family builds. I mean, the reality is we are still so far undersupplied. We still haven't recovered from the Great Recession in terms of being undersupplied as a market here in Jacksonville and as a market across the country. I was just reading John Burns, listened to his monthly call, and they estimate that we are, as an entire country, we are 1.7 million homes undersupplied. And that's because we just stopped building once the Great Recession happened. We haven't recovered yet. We're going to need to build 17 million houses from 2020 to 2030 because due to the demand of families and in migration and things of that nature. So, I'm not concerned about the fact that we've had such an apartment build. And, as we're starting to see the recession start to take form, you're actually starting to see capital stop investing in some of those apartment complexes and pull back. So I think you're actually going to see a stronger pullback in the amount of starts on apartments than you will in single family houses. So, I think it's something to be aware of, but certainly not something that's concerning me. I think right now there's a reason why John Burns and others expect rental rates for single family homes to continue to go up, largely like they have every year, about the same rate. I think John's expecting 3.3% rent price appreciation for single family rentals here in 2023. And so I think we're good, even though we have had a big apartment build.
Not to bring it back to the whole category thing, right? But like if I think in the category mindset, right? Like basically that concept is you first think about what supermarket aisle you're going to walk down and then you go buy the product, right? Like I wonder how much that demand for housing really overlaps between multifamily apartments and single family homes, right? Like it's kind of like, is the same person that's buying a minivan also the person that's going to go buy a Mustang? I don't know. Right. Yeah. So like it might be, it is housing units. And I'm sure that if I'm a 25-year-old person that can get a house or an apartment, I'm going to go house at the same price. Mm-hmm. But when I'm a family and I need a 3-bedroom house, there's not a lot of 3-bedroom apartments that you can have like with kids and whatnot. Right. Like it's a different asset. Right.
Yeah. And you have an opportunity to do this now. And you'll have the opportunity to do it in a single family rental community, which people just haven't had before. So you could see pulling demand from the apartment space into the single family rental space. So definitely something to be aware of and take notice of. But yeah, I think we're sitting pretty from a supply side.
Cool. A couple of cool comments. Eddie Harris says that JWB is the Tesla of the rental market, which is right on point. Category king, right? And Kyle Barton says people don't realize the challenges of vertical integration. Looking forward to see JWB separate themselves even more as institutional money keeps flowing. And I think I think we agree with that one as well. Jenny Berger's asking, are y'all still offering the 10K incentive package?
We are, Jenny. Today is the final day of the JWB incentive package. So if you are on the fence, I would encourage you to reach out, jump on the phone right now. We do have inventory available, similar to the inventory that Dean put under contract last Thursday for the property of the week. I know a few folks emailed in and were interested about the home as well. So yeah, reach out to the team and hopefully we can add a couple more properties here with that incentive package.
Cool. And Not Your Average Guest puts in the chat also, I think a lot of people would be better off investing in direct JWB type single family rentals, but there really is not enough supply of good, well-managed single family rentals for millions of investors. No, this is kind of what we're talking about.
Yeah, I think that's a real challenge. I think, when you look at the desire for folks to do something other than like the Wall Street Journal Money Podcast talked about investing in cash just to get through this recession. There's a desire to find something different, but usually the experience that comes along with investing in rental properties scares people, and that's what holds people back, and it's a shame. And so, in our little hole of the internet here, we're trying to show people a better way. But yeah, there's a need for more companies like us, because I think when people can invest in this asset class, it can improve their family life. I think it can improve community. I think it can improve the country and the world. I really do. I think that there's a space for a consistent asset class like this to help. So I hope more folks join the party.
Agreed. Mountain Man Bill Green checking in late. He says he's literally looking at 5 JWB properties right now to beat the deadline.
Love it. That's awesome, Bill.
Mountain Man's getting after it. So we have a little bit of a tangent going on here with the EVs, right? Michael Santorios is saying, hey, with the IRA or maybe the IRS, $7,500 credit towards buying EVs, do you think that installing an EV charger outlet will help them get rented faster or for higher rates? And Raj Bantu is also saying electric vehicles are getting more popular. People with EVs prefer single family properties so they can charge their EV at home. Any thoughts around the idea of that, GC?
Honestly, a thought never crossed my mind. I think I don't know. It's a good question. I'll bring it back to the team and I'll ask.
Okay, cool. I love it. I mean, just to kind of like let everybody know, right? You all make decisions on what you build into the houses based on the data of what is going to make that asset perform better for investors, less so than like what makes it cool, right? So I would imagine that that's kind of, right on the fringes of things, but you guys have data and you guys can do that market research, right?
I have no idea what it costs to install one of those chargers. So it would, gut feeling is that it would be hard to make the numbers work. But again, I have no concept. Maybe somebody does. $500? Really? Yeah. Who knows? Maybe.
Interesting. Okay.
Bring it back to the team.
All right. Bring it back to the team.
Cool.
Joe Culler says, what do you think about the concept of buying shares of properties, earn rental income and appreciation, like Arrived? What do you think about that, Juicy?
Very interesting. Very interesting. Can I leave it at that for right now?
Yeah, if that's what you want to do. Is that what you want to do? Just everybody could just look at his sly smile and infer that he's thinking about this when he's sleeping, or what?
Yeah, I've been really paying attention to this space, this fractionalized ownership space. And, I think that this democratization of investing in rental properties is a huge opportunity. As I mentioned, I think that this really can change how our country invests if you can make it more accessible and more easy for folks to take advantage of another asset class other than stocks and bonds. And I think rental properties, when you look at the numbers like we have talked about over and over and over in our community, you can get 10, 20% better returns than the stock market. And it's a consistent asset. So you just have to work on access. Ease and access. You have to reduce the barriers to do this. And there are companies like Arrived Homes who have been pioneers in figuring out how non-accredited folks can invest in fractions of single family rental properties. And so I actually have a really good communication with the folks over at Arrived, and we've worked with a couple of different companies who are early pioneers in this space. And it's something it's high on my radar. So there you go. There's my wry smile. I'll leave it at that.
Yeah. GC's definitely working on something like that. All right. Bill Green, who's in the middle of making an investing decision. I guess we got to sneak this one in here, give him a little bit of value. Asking, are there any strategic considerations per JWB properties where one should consider a single family home over a townhome?
Mountain Man, great question. We choose the townhome communities that we offer very specifically. They are in the same JWB neighborhoods, right? That way we know exactly what the rent amount should be for a townhome versus a single family home, because there might be some differences there. We know how to make sure that your risks are mitigated. Sometimes you have a risk of, a townhome, a homeowners association president or board making decisions that could inhibit or hurt your overall returns and profitability of your investment. You don't have to worry about that with JWB's townhomes, because sometimes we even set the board of directors for the HOA, which we have done on occasion. But more often what we do is we have great influence on the board of directors or how HOA decisions are made. So all that being wrapped up to say, you can look at investing in a townhome with the same criteria as you have with a single family rental home. And so, it all comes down to the numbers there, right? We've reduced any of those other variabilities that you may have seen with other townhome purchases. So now you can just look at the numbers, start with the IRR. And townhomes represent a really great opportunity for you to typically get in a lower purchase price and get newer construction. Typically your new construction homes are going to be, call it $250,000 to maybe $300,000. And townhomes usually are an opportunity to get newer construction and being a little bit less. And they still shake out to those returns with the incentives. I think your returns are coming in somewhere around 13.5%, 14% IRRs. So yeah, Bill, if that's what you're thinking of, I think it'd be a great investment for you.
All right, GC, I like it. He says, "Gah, you said HOA, LOL." Thanks. Thank you for those answers. I appreciate it. Cool, Bill Green. Happy we could help. All right. We have a fascinating discussion in the chat. This is what I love about our community, right? Like we have our show that's going on. We're talking about something, and in the chat, people are making friends. There's a fascinating discussion about the cost of installing EV chargers, solar panels, and the benefits. Like Leslie Wilson's installing solar panels in Denver. Michael Santoris is installing solar Tesla chargers in his home. I love this stuff. Keep it going. I'm fascinated by the whole electric charging market and the environmental impact of all of it. So I love that there's things being interchanged. But you see, to put a button on this whole white collar recession thing, to me, my takeaway, my Instagram reel moment is this idea that recessions are nuanced. This one seems to be something that's really going to affect the households that are generating more than $100,000 a year. And what that is going to reflect is essentially that we're seeing the signposts of Amazon hiring factory workers, but laying off knowledge workers. People are not going to Disney. Therefore, Airbnb and short-term rentals are probably going to be affected before long-term rentals get affected. And then this idea that this is driving people to think differently about money. And it's leading to people really opening up their minds about kind of different investing practices. You got anything?
I love it. I'll add on the short-term rentals thing. You guys have asked about short-term rentals and Airbnbs for JWB, and over the years we have about 40 short-term rentals, number of units, probably about 20 properties or so, and but we haven't made those available for clients. We don't do property management for short-term rentals. And, the reason that we did not jump on the bandwagon like everybody else and start to market and sell these things is because we need to see how they perform with our own money, first of all, in different market conditions. And so, it's something that we've invested in, but I think that, people are going to learn how this thing works in recessionary times. And there's something to be said for how recession-resistant single-family rental properties are for long-term rentals. We're going to see on the short-term side.
Cool. Interesting. All right, GC, let's move on we got two more topics to hit in these last 15 minutes.
That's all right.
But I think they're less big concepts than we were doing just now, right? So the next one is this idea, again, following along with this trend of white-collar recession. Wall Street Journal just published this idea. Google, parent Alphabet, right? Alphabet, the company that owns Google, cut 12,000 jobs amid a big wave of tech layoffs. Other people that are saying that are cutting jobs are Microsoft, Salesforce, Wayfair, all cutting thousands of jobs. This one, GC, was something that you put on my radar. What do you think of that? What do you think of these headlines from Google coming out here with?
I think it's what we expect to we have been talking about how telegraphed this recession is, right? You would expect big jobs cuts to start happening. We're starting to see them come in. We see a new, headline, seems like every single week. Like Eddie said, the companies that do these layoffs, you don't want to be the last one to do a layoff, from a profitability perspective. You don't want to be the last one to do it. So that's why Eddie said, they're going to do it in the beginning. They're going to get out in front of it. If they've already determined that they're going to need to do it, they're going to get out in front of it. And that leads others to having the cover to do layoffs and things of that nature. So I'm thinking about it from a big picture perspective. Obviously, this isn't how I think at JWB or how we think, but this is, going towards what we have been saying, that there is going to be a recession. And then the thing that I was reading as I'm reading this, I'm like, man, this is Google. when we were thinking about how to create a culture here at JWB and the amenities that we brought, we talked about making it like Google. And you think about the culture that Google has created, you would think, and this is the other thing that jumped out to me, Google made $17 billion in profit just last quarter. So to me, it's kind of disheartening. I understand that this company, Google, has to be run differently than JWB, but it was surprising to me that they're supposed to be the standard for how to build a culture. And it's not the fact that they had to lay people off. To me, it sticks out to me because there were a lot of companies that rushed to hire last year as sales were up everywhere last year. They rushed to hire. And I listen, we're nobody like Google, but we planned years in advance and we make hiring decisions. We're not going to hire a position unless we expect that position to be there for years. We're not going to make a decision to bring somebody on and just hire them to capture a short-term opportunity, only to have to tell them 6 months from now or 9 months or a year later that, listen, this job no longer exists. To me, it just seems like, Google could have had more foresight. You made $17 billion last quarter. And, I would expect their culture to suffer from that. But, different companies evaluate the profitability and the loss and the short run gains and the long run losses differently. And, it's different than how we would do it at JWB.
Man, do you see, when you tell me this, like, I know that this sounds like a business leader being like, yeah, man, why couldn't you have done it better playing armchair quarterback? But this, you telling me this, you saying this really strikes home. It brings me back to, I think it was the end of 2020, beginning of 2021, right? Like we were bringing in my partner at the time, right? The rest of the marketing team. You brought us all together to like plan out what the next iteration of the Not Your Average Investor show and JWB marketing efforts were. And it was the first time that we walked around downtown and you showed us all this stuff that's happening with the city. And we knew at the time that there was more demand from homes that were being gotten to, right? Like, and I remember my team just being like, Gregg, what you need to do is hire a salesperson, right? Like you have all this interest. This is the time to capitalize. The asset class has never been more popular. There is far exceeding demand and supply. Why aren't you bringing in more salespeople to capture all this attention that we created and goodwill that we created from the show? And you, as we were just trying to map out 2021, you said to us, listen, man, we've been here before, right? Like we know the cost of our culture and the psychology of our team when you let people go. It is bad. And we bet on our team to be the number one asset that people invest in. And we can see far enough into the horizon that at some point this demand is going to die down. At some point, there's going to be a correction in the market where this asset class is going to be a little bit harder to sell. And I am not willing to bring on a position, 2 positions, 3 positions to go capture this thing right now if I know that within the next year or 2, I'm not going to have a job for them. Like we are willing to take that loss of growth and revenue to preserve the culture that we have here at JWB. And we were effing flabbergasted. like I can't tell you how Isar and I walked away from that just like, what the hell is going on here? Is the world upside down? And just super impressed with the fact that you would make that decision. So when you now say this about Google, I can't help but think of that conversation and think of the fact that you really do put your money where your mouth is when it comes to this idea of long-term planning, value of the team and service as being the ultimate competitive advantage. And you just really, really stick to that. And this whole idea that we're saying, you see it, the tea leaves are talking about it. The recession's coming. These are the things that are going to happen. Like you have always acted the same way that you're preaching right now, which is really impressive.
Well, thank you, man. I mean, try to put a value on being able to stand up in front of your team when the pandemic happens and to go up in front of them the day after sort of the world changed and say, nobody's going to lose their job here at JWB. right? Or now where your team is reading 12,000 job cuts for Google and Alphabet and Wayfair and Salesforce cut, Salesforce, I think, cut 10% of some part of their staff or whatnot. I mean, thousands and thousands of jobs are being cut, all in all in all. There is no chatter about anybody losing their job here at JWB because of a job cut or a position not being available. I mean, we don't even have to make an announcement right now to JWB. It's so far off the radar. People feel secure in the vision here at JWB, and try to put a price tag on that. Like, what's that worth? To us, that is worth more than selling, you name it, 25, 50, 75 homes when we could have done that by hiring additional salespeople for that, temporary spike of demand. So that's really what it comes down to.
I don't know if it's in my place to talk about this, but it's one thing when you're talking about Google, and it's another thing when you're talking about, like, I was at Spike Ball on Sunday, right? Those guys that we all play Spike Ball with, a lot of them are in real estate. A lot of them are like struggling to like find deals and do things. And a lot of the conversation was dominated by, there's two other like big outfits here in Jacksonville that grew immensely in the last couple of years. They're awesome, awesome dudes, like great company, great cultures. And in the last month or so, they've announced giant job cuts, right? So like, I know that this thing strikes close to home, and it isn't just that real estate is performing a certain way. It isn't that you're not big tech. It's not just Jacksonville market. Like, it really is this idea that, Madison's putting in the chat, right? Like, she never crossed her mind that she might lose her job because of the amount of stability that you've created has built this like bus where everybody is in the right seat and they're all going somewhere that they really want to be. It's pretty incredible.
Yeah, it's amazing what you can do when you create that type of safety, security, and you let good people do what they do, and that's paramount. That is at the core of every decision we make here at JWB, and that's why clients have a great experience at the end of the day. So yeah. It starts to make sense when you kind of put it in that context.
Makes perfect sense to me, man. All right, the last thing that we wanted to bring up is Jacksonville unemployment. Right. There have been recent articles here. I'm going to share one right now that talks about Jacksonville's jobless rate falls to record low in December. Unemployment dropped to 2.1% in this metro area with holiday hiring and job gains. What do you say about that, GC?
Man, 2.1%. I think people don't understand how low 2.1% is. So I wanted us to, we'll leave our session here today with a little bit of perspective here. I went and I looked up the average unemployment across the country here for the last, 40 years, 50 years, whatever it was. Average unemployment's 5.75%. 2.1% here in Jacksonville is so low. So as we're kind of putting a buttoning up and putting a bow on the conversation today, we've been talking about how job cuts are happening. They are going to continue to happen so that we can solve this inflation problem. Just know that we have a lot of room to go to where we can absorb some more job cuts as it's not nice to talk about. I don't want anybody to lose their job. But if people are going to lose their job, I want to put my money in an asset class that has proven that it can perform as unemployment rises. Because when unemployment rises, stocks usually don't do well. But unemployment here in Jacksonville is so low that we can absorb some more job cuts. So I went back and I looked at different points in time. Did you know that in 2012 in Jacksonville, our unemployment rate was around 8%? It wasn't just 2012.
2012?
Yeah, in 2012. This even shocked me. I was looking this up right before the show. In 2014, and this is from Fred, Federal, Fred. Look up Fred. Federal Reserve Economic something. So it's the national data. So 2014, meaning it is about, it's the government data, but it is
Federal Reserve Economic Data. I'm all over it, bro.
There we go.
I was looking up Recession to post links in the chat for people, but instead I looked up Fred for you.
Thank you so much. I was stumbling over that. So that's federal Fred stuff, but it's all about Jacksonville. So 8% was roughly the unemployment in 2012, right? Clearly Jacksonville rental properties were performing in 2012. Rents were coming in. In 2014, we had about 6 to 7% unemployment in Jacksonville. 6 to 7%. 3 times what we have right now, and then some. And in 2016, we had about 4 to 5% unemployment. So it is so shockingly low right now. So as I said, I've been investing for 17 years. Unemployment has always been higher than what it is. And rents continue to come in. You look at those client success journeys that we do on our properties of the week on Thursday. And you see folks that have been investing for 10 plus years, right? We had Jen Filson on the show last Thursday, right? She was investing in rental properties in Jacksonville while unemployment rates were 4%, 6%, 8%. So just have confidence to know that this is an asset class that is built to perform in normal times, and it really starts to shine in recessionary times. And not all asset classes are built to be able to sustain job losses like we're going to see.
Makes a lot of sense, man. I when we do our morning runs, to me, I'm always thinking like, what I'm really thinking, what am I thinking as our typical investor out here, right? It's this idea that, if there is a risk here, it is vacancy happening during the recession, right?
Mm-hmm.
Like that is a very natural thing for us to be thinking about. So I'm glad we found this statistic, right? Like this idea that during the most prosperous times of this asset class, the unemployment rate was 4x what it is right now, gives me peace of mind to think that, okay, so if it starts going up right now in the short term because of this recession, whether it's blue collar or white collar, that doesn't necessarily mean cause for alarm for myself, right? It doesn't necessarily mean that this is going to go down based on past performance. There's plenty of space to go here for this thing to still perform and over deliver the same way that every other Jacksonville property is done for you guys.
That's how I feel.
Cool. All right, man. Well, I think we got it in right on time, man. 1:30. That was Not Your Average Insights, White Collar Recession Edition. So what'd you think, man?
I love it, man. It's great.
Yeah.
I feel like we haven't done this in a while.
It's been a while.
So it's just nice to sit here and shoot the and have a good time, man. Hopefully everybody enjoyed it.
It is. And, it's done great I love that, like these types of shows is what really drives the community, right? Like we had 51 plus people still here right now. We had the side comments in the chat. We had a bunch of great nuanced questions. Just the fact that our community takes an hour out of their day to like be here and join in on this conversation. That's what makes it fun for me. So thank you for being here. If you're listening on the podcast, if you're watching on YouTube, join us one of these days, get in on one of these random comment sessions that happen in the chat, be part of the community. And I'll leave it up to you, man.
One thing we did not plug specifically was the JWB Not Your Average Investment Tour. So that is coming up on February 25th. I think we already have 15 people that are already signed up, paid, ready to go. I think we have another 20 or 30 that are close. They're close to signing up.
Jeff Wonder just booked his flight. He's coming.
Oh, fantastic. So yeah, it's going to be a ton of fun. So I hope you all can make it. If you'd like to sign up, if you'd like to get more information, go to jwbrealestate.com/tour, jwbrealestate.com/tour. It's a full day on Saturday, February 25th, $39 to attend, includes the whole day. We got a bus tour plan. We got lunch covered for you. We've got a happy hour towards the end of the day. So going to be a ton of fun and hope you all can make it. And thank you to all the newbies who showed up today too. We've got a lot of new folks. Thank you all for being here. Thank you for saying something in the chat and coming into the light like our friend Aaron O'Neill. We really appreciate you and thank you for helping the show to grow.
Real quick, Richard Hall has a Q&A saying, are these recorded if I miss some content? Richard, good news for you, man. This is right now live on YouTube. By Monday, my team takes this show and then repurpose it and packages it specifically for YouTube for the Not Your Average Investor Show channel, which is JWB's YouTube channel. We also release these on podcast. So anywhere that you like to watch content or listen to content, podcast or YouTube, if you put Not Your Average Investor Show, you will find all of the recordings and all smaller bits of this. You can also come to our Facebook group, jwbfacebookgroup.com, or look for Not Your Average Investor in Facebook, and you'll get to meet all these folks, and you get to continue to buy this. Good to have you here, Richard. That's another new name. Good to have you here, Richard Hall. Hope you keep coming by, but if you can't make it, it is out there on the internet. And what was I going to say about the tour, right? Like jwbrealestate.com/tour. We're getting this bus. We're going to go do a live property of the week, and we're limiting it to one bus. So what that means is we already got about 20 people. There's another about 20 or 30 people that are interested. So if this thing might fill up is what I'm sensing. And there's a cap to capacity on one bus, because what we realized last time is being on two buses, Gregg and I just missed each other just too much. So we want to spend as much time together and with you the whole time, so we can all just like partake in this community, be as helpful as possible. So don't delay, sign up, make your plans. It's going to be awesome. And from here until now, see you on the Not Your Average, see you on the Property of the Week. And